Welcome to Better Business for Good TV, Small Business Matters. I'm your host, Brenda Thomson, co-founder of the Better Business for Good company. On today's episode, I'm talking with Martin Cattach from Finance for Business about funding and finance in post-COVID Australia. This episode was recorded live using a mobile phone at a recent Better Business for Good and Just People's Connect, Collaborate, Contribute event, so apologies for the sound quality.
Small business matters because it's all about things that matter to small businesses, and also because small businesses do matter, and I think we get forgotten sometimes in the big scheme of things. So today I'm talking to Martin Cattach from Finance for Business about funding and finance in a post-COVID Australia. I'd just like to ask everyone to keep your questions to the end, but there will definitely be time for you to ask questions over and above the questions that I'm planning to ask Martin. So at the end, we'll just do the hands up thing, and you can pop up on stage to ask your questions at the end of this little chat with Martin. So just to introduce Martin properly, he's had a rewarding corporate career working in the key growth markets of financial services, investment banking, information technology and market research. But for the past 10 years, he's been working exclusively with small business because small business matters. And his methodology is about helping small businesses to access innovative, flexible, lower cost methods to fund business growth. He's the Director of Finance for Business, and his mission is to provide small businesses with the working capital and cash flow they need to succeed, grow and prosper. So welcome, Martin. It's great to have you here. And I'm looking forward to chatting with you about funding and finance in post-COVID Australia. So did you just want to I've got some questions for you, but I thought it might be great if you just put that in context as to why that matters for small business right now.
Yeah, thank you, Brenda. Small business are almost all interdependent on each other. So one of the things that in this post-COVID world we have to think about is that most small businesses deal with other small businesses most of the time. So the thing that makes it important is that because there's an interdependence and a reliance on other small businesses in your supply chain, or often they're your customers or suppliers, the situation is that you need to think about what all the small businesses around you are doing as well as look at your own business. Because the post-COVID world, and is it really going to be a post-COVID world? Because we really don't know. I think the vaccine is perhaps not going to be a panacea for all our problems, and there are going to be some pockets and problems with this virus hanging around, and perhaps the next virus around the corner. But from a small business perspective, the market and world we live in has changed, and the old rule is where there is change, there is always opportunity. So that's what business needs to look for.
Right. So what do you see as the outlook for small businesses in the finance and funding area for the next 6 months?
Look, I think that for the smaller businesses, and I'm talking businesses maybe up to about 5 employees, I think things are going to be very hard, mainly because the traditional support from the banks and that is starting to disappear. Many people in the banking industry are saying that any business that employs less than 3 people, they've already written off. They're wondering what will happen next. These are the rumours one hears about in the industry. But small business is going to have to look at different ways of doing things, and perhaps of funding things, because I feel not so much now, but in the next 6 months, we'll find that the bank attitude to providing facilities is going to tighten up, and there's going to be a lot of pressure on the business as far as how they fund and move forward. Particularly in this current environment, you either grow or die. So unless you're, you just can't do business like you used to. This is a different sort of playing field now. So you have to look at growing your business, and you have to think about how you're going to fund that.
What about things like government guarantee loans? Are small businesses getting those?
In the areas that I work in, I do not have one client who's managed to get a small business loan. And I speak to other advisors like myself, and they are also in the same boat. The situation is that the government guaranteed loan in the industry is considered a great marketing tool, and we can hear the banks telling us that they're doing all these lovely government guaranteed loans, but in reality, banks have tightened their credit criteria. If you could get a loan off a bank before the government guarantee came in, you'll possibly get a government guaranteed loan. If you couldn't get a loan before the government guaranteed loans, you won't get it. So the government guaranteed loan is passing half of the risk of the loan to the government, but the banks in their assessment criteria are basing it on their taking all the risks. So it really, I have not met someone who has got one in all my travels. So I call it a marketing scam. All the banks are telling us, because the banks have come out of this after the Royal Commission, where their reputation was somewhat sullied, have been quite helpful with payment holidays and so forth, but all of that's about to end, and the government guaranteed loan is something they can keep holding their heads up high and run the publicity machines, where in reality the helping of small business has not been great besides the payment holidays, and I believe is going to get a lot tighter from now. So the banks are going to wield their big stick.
Which probably leads into the next question I had here, which was about how do you think big banks are treating small business customers? Did you want to expand on that some more, or do you think we've really covered that?
Well, look, I'm not just here to can the banks. Banks are a very viable thing, but I'm seeing that they are basically all the banks in Australia, the big banks, are mortgage lenders. So all they want to do is write home mortgages, and if they want to do any business lending, they won't do it unless they have a security of a mortgage. So that's a bit of a limitation for many people, and there are now different funding alternatives besides the banks, and some of the new fintechs, while they are not as cheap as the bank, they do things unsecured. So businesses need to look at their various options and perhaps look at debt, as I always say, is a similar way one should look at investment, and that is have a spread. Have some of your borrowings with your bank and have some of your borrowings elsewhere, so no one contains all of your business.
So what are some of the other options other than, you just mentioned the fintech companies, and obviously we know about the banks. What are some of the other options available to small businesses?
Well, some of the things that are very popular, but say particularly in England, that we don't see used here, are tools like debtor and trade finance. Look, most Australian businesses have a shortage of working capital, and that's a problem, because a lot of their working capital is tied up in their debtor book. In other words, the people that owe them money. So something like debtor finance can unlock some of that to give the business more capital. There are also things like trade finance that can help you on the other side of the ledger, which is looking at your creditors and helping you manage those and providing funding for that. And the fintechs are very big on doing working capital loans. If you've got a reasonable turnover and a reasonable credit history, they're very easy to get reasonable amounts, generally 1 or 2 months turnover on your business. So if your business is turning over 1.2 million, a fintech will give you between $100,000 and $200,000 in a working capital loan. Far more flexible than banks. It is more expensive, so you have to weigh up what sort of return you can get on those funds, but they are a viable alternative for small business.
And just to wrap up, what do small businesses need to do in the next 6 to 12 months, do you think, regarding their finances? Do we have a nice to-do list?
Look, I suppose the things that I would put on the to-do list is that we're coming into uncertainty. JobKeeper's stopping. Our economy has had some fundamental changes. We don't have overseas students coming into the economy. We don't have any immigration. So things that have changed in our economy are substantial. And at the moment, because there's been a lot of pent-up demand, everybody thinks we're in a sort of a mini boom. And we may well be. Look, I don't know. The government incentives that may have been enough to get us out of this problem. I tend not to think that the jury's still out on that. The situation is that what a small business must do now is look at where they're positioned. They're going to have to look at growing in their market because some of their competitors will fail. But more importantly, they have to be careful about people that owe them money. That's the debtors, because if we're in uncertain times in the economy, some of the people that owe you money will fail. And so you have to try and look at managing your credit terms very tightly, and be careful because your business may be doing well, but your customers may be your greatest threat.
That's definitely a talk to Janine moment.
Exactly. You've got to make sure that people are paying you the money they owe you, because as the banks tighten, they tend to use their suppliers as the second bank. And so you don't want to be that second bank because you don't want to take the risk.
Yeah. So those were all the questions that I had. I'm sure we're going to get some from our audience. Before I move on to that, is there anything you wanted to say to wrap up, Martin? It was really interesting.
Look, I think that the situation is it's just uncertain. So, some of the economic indicators are saying things are booming, housing prices are going up because money is cheap. But I go and look back at the GFC, and there was a similar effect just after the GFC, and things didn't really happen, and the pain didn't start to wash down until 12 months down the track. So we're only 6 months down the track, and we don't really know what's going to happen. So I think the thing is to be caution. Caution is the word, and to be conservative and to be cautious, particularly when you provide customers with credit terms and fund their business for them.
Right. Thank you so much, Martin. That was really interesting. Now I'm going to, if anybody's got questions or comments, if you can put your hands up, then we'll get you up clearly to get so everybody can hear the questions and the comments. We need to bring you up on stage. So please, if you've got any questions or comments for Martin, pop your hands up and we'll bring you up on stage so we can chat. Okay, so Lisa, can you help me bring the people with their hands up on stage, please? That would be fantastic. Okay. So Steve, I think I saw your hand pop up first. So what was your question or comment for Martin?
Yeah, just I'd like to drill down a little bit more into the comment around if you have a business of 3 people or less, the banks have effectively written you off. What does that mean, Martin? How can a bank write a business of 3 off? If they're trading okay and sales are still coming in and cash flow is still coming in, I didn't really understand your comment. Could you expand, please?
Yes, look, on that comment, what people in the banking community are saying, when we say written off, the term is no more credit. So the situation is that 3-person business is considered on their risk profile to be the wrong side of the curve. So they're saying those smaller businesses represent too much of a risk. They will not be able to get additional credit to grow or change their business from the traditional banking. So that's what I mean by written off. It's a credit term is we don't want to lend them any more money. If that makes sense, Steve.
Yeah, so effectively they're maxed out.
Yes. So putting an application to your bank now to buy anything but a car, which they tend to like to do, but any sort of equipment or anything productive, in particularly those smaller businesses, they're not really interested.
Right, thank you.
Thanks, Steve. We might kick you off the stage. Kerry, I think you were next on my list.
Yeah, I've got a comment actually in response to what you just said then, Martin. My niece, she's like my daughter, Storm, She's 24 years old. She bought a car a couple of years ago, and she's had a massive career changes, which has meant she's got a car of her own, a work car, so she sold her car. She sold her car for more than she bought it a couple of years ago because cars, secondhand cars, she says, I don't know about this, but have actually appreciated because no one's buying cars. Everyone's moving to work from home and reducing their commutes and I just thought that was a fascinating thing. I've never seen a car as an asset before. So have you seen things like that, Martin, where crazy stuff is shifting like that?
Well, particularly in the car market, in the US, The Economist had an article recently that used car prices in America doubled. And the underlying reason for this was that nobody wanted to get on a bus or use public transport. And so there was an increase in demand for used vehicles. And in America, a used car you buy for $500 is the same used car you'd buy here for $5,000 almost. They were increasing enormously in price because people wanted to stay away from public transport. So that caused an increased demand in the motor vehicle market.
And I guess there's also a thing too, people maybe can't afford a brand new car right now, so second-hand cars will be faring really well in that situation.
Yes, that's true. Second-hand cars are representing better value, and many of us don't have to drive to work anymore. So we don't need a new car as much as we thought we did.
Yeah, there you go. That was it. Other people with questions, so I'll finish up.
We'll kick you off the stage, Kerry. Mark, you're next along my screen. What was your question or comment?
Hey, Martin, thanks for inviting me today.
You're welcome, Mark.
Okay, so can you tell me a little bit more about pineapple funding or apple funding? Because it's driving me absolutely nuts. I'm getting emails, SMSs. They're asking me, like they're making the assumption I want money. They're constantly texting me to say, hey, we've been trying to contact you. We can get you between $2,000 and $20,000. You're quite aggressive in terms of, like, I'm thinking, why don't you pick up the phone? Like, talk to me. But, like, in the end, I just went to hell with it. I'm saying $10,000, it just didn't happen. They haven't contacted me back. But obviously there's players coming into the market that obviously aggressively wanting to loan you money. So there must be money out there unsecured. Do you know anything about this, Mob?
Yeah, look, I don't know a lot about them, but there are what I call a couple of push funders. And push funders are people that use electronic means, email, SMS and so forth, to offer small business people, and they've generally scanned all the websites and picked up mobile numbers and email addresses from there. And it's their marketing strategy to push money out the door. They do similar unsecured lending to what you effectively get on a credit card, generally at higher rates than what you get on a credit card, which are already incredibly high. And using modern tools like reading your bank statements and checking your credit score, you can make some reasonable assessments of how someone will do for credit, and basically they'll throw $10,000 at anybody to get them on the books, and they don't ring you up and talk to you because that's a very expensive way of dealing with a customer.
But
If they can do it all electronically and...
Like, they only want to know my monthly turnover. That's it.
Yes.
Okay.
Well, and then the next question is they'll ask for access to read your bank statements.
Okay.
And so they can see, verify your turnover, see what your expenses are, see what your income is, and make some assumptions from there. But there's a new thing in credit now, and that is read a company's bank statements or an individual's bank statements, because read-only access is granted by the banks, and that gives a very informed picture of what's going on in that client's bank. And well, not their bank, but so much their trading position.
Okay, thanks for that question, Mark. I'll kick you off the stage now. Andrew, you're the next person along the line.
Yeah, thanks, Brenda. Martin, I was just interested to know, in terms of market positioning, that the fintechs that you mentioned before that are lending unsecured, do they have a significant share of the SME lending market? I mean, how does it compare with the banks? Are they minnows next to whales? I mean, are the banks looking to compete with the fintechs, or and where do the fintechs raise their money from? Which is sort of a collateral question to all of that.
Okay, firstly, I don't actually know the market share they hold at the moment, but considering what I'm seeing, it's growing. What they're owned by the banks, right? You've got to understand that the fintechs are basically half owned by banks. Okay. In reality, they fund from the bank, and if you're a bank, there's sort of a split in the market. If you're a bank, you secure your money by mortgage, and if you're business lending on an overdraft, you're charging between 6 and 8%. If you're a fintech, you don't take that security. You're funded by the same bank, but you're lending at twice that rate. So they're lending at, say, between 12 and 18%. So it's a rate for risk type calculation. So they are lending money unsecured, but at a higher rate. But they basically, because they're able to read your bank accounts, they know exactly what the bank knows about you. They are just take a different risk profile because they have a substantially higher yield. And at the moment, I would say that, if you look at a business that has bank borrowing, they're finding they can't get any additional funds from the bank. They can't get an SME guaranteed loan. So they're looking at, if they need some additional working capital, they're looking at the fintechs, and the fintechs tend to lend at a higher rate, but over a much shorter period. So the fintech loans are often 12, 18 months, 3-year maxes. So they can manage their risk in a shorter term, and they get a higher interest rate for it.
Mm-hmm.
Okay, thanks, Andrew. We'll kick you off the stage, Marie. This might be our last question, I think.
Yeah, no, this is just a couple of quick questions, Martin. Just with regards to the lending to small businesses, I assume you're talking about business loans. You're not talking about business owners being able to use the equity in their homes and increasing their mortgage.
Yes, I'm talking mainly about business loans.
Yeah.
Increasing using the equity in your residential property is something that all small businesses are forced to do.
Yeah.
I am just beginning to see, because the banks are a little bit nervous, as am I, about the retail residential property values. At the moment, we have a boom running on, but there are substantially large numbers of the community in certain areas are under mortgage stress. Bank profits for the last 12 months are down 30%. So the banks are a little bit conservative about what's going to happen, and they're beginning to say, well, yes, you have equity in your house, but the risk of us giving you more money without completely understanding your business, I think you're going to find that's going to start to tighten up. It isn't yet, but it will as the banks become a little more nervous.
And surely it'll be business dependent, because I know banks love, like, for example, giving lending to doctors and, other businesses that they see as being stable.
Oh, yes. No, they still have their preferences. But I suppose one of the things that the information revolution has given us is that banks now have the largest data warehouses in the country.
Yeah.
So they can look across many industries and have their daily transaction trading for all those industries and categories. So they can get an understanding of what industries are at risk. And if you're a plumber in Victoria and plumbers throughout Australia are doing badly, the bank's going to put pressure on you.
Yeah.
Not necessarily about your business, because big data is driving a lot of their decisions.
Yeah. The only other thing is our clients in COVID have been using the ATO as a bank, because they will give you pretty good rates for 2 years. So.
Yeah, look, the only problem with using the ATO as a bank, which I call them Small Business Bank Mark II, is that the situation is that the tax office is going to start looking for revenue very shortly. Yeah. And external lending bodies, and particularly the banks, get very nervous when they see tax debt.
Yeah.
Because the ATO is a preferential creditor. and that will mean that the bank can get pushed out, or any unsecured lending they'll lose because ATO gets first call. So many lenders, as soon as they see ATO debt at the moment, won't do anything until the ATO debt is reduced. So it's a management type thing. If you're going to use ATO as your banker, which many small businesses do, you can't use any other bankers.
Yeah.
Besides what you've got. In other words, you can't get any more credit if you've got an ATO debt in the majority of circumstances. There are exceptions, but the ATO, particularly if the ATO debt is large, if you want to refinance your house and you want to change to a different bank because the rate's better, you've got a large ATO debt, the new bank will not accept you.
Okay. Thanks, Peter.
Okay, thanks, Maria, and thank you, Martin, for that really interesting discussion on funding and finance.
I hope you enjoyed this episode of Small Business Matters. In the next episode, I'll be talking with Katie Patterson from Katie Patterson HR about if, when and how to manage redundancies following the end of JobKeeper. You can catch the recording by subscribing to the Better Business for Good newsletter, or join us live for Connect, Collaborate, Contribute with our impact partner Just Peoples on 28th April. All the details are on our website at bb4g.co.